All right, welcome to this explainer. Let's jump right in and decode what is honestly the ultimate financial trap, and it's probably hiding right inside your banking app. So look, we've all been taught that saving money is, the absolute peak of responsible adulting, right? You put a little away each month, $100 here, $200 there, and you kind of pat yourself on the back for being financially mature. But while you're busy feeling like you've totally mastered your money, there is a mathematical reality quietly working against you, keeping you from actually building real wealth.
Picture this. You do the responsible thing. You stash away 10 grand in an account earning something like, say, 0.5% in interest. After an entire year of just unshakable discipline, you log in and realize you've only made $50? Yeah, $50 for a whole year. And honestly, it gets worse because once you factor in the rising cost of everyday life, that $50 doesn't even cover the inflation on your groceries. So your money didn't just sit there safely, it literally lost its purchasing power.
Now you hear your friends or your coworkers or the news constantly talking about index funds, bull markets, and the magic of compounding. And looking at your own $50 gain, which again is actually a loss against inflation, it forces a really uncomfortable question. Wait, am I doing this wrong? It honestly feels like there's some secret rulebook everyone else got handed and you just got left out of the loop. Well, here's the undeniable truth we really need to unpack today. Saving money is fundamentally good, for sure, but saving alone will almost never make you wealthy. And that's because saving and investing just have two completely different job descriptions. Think of your savings as a heavy metal shield. It's designed exclusively to protect your money from harm. Investments, on the other hand, are like planting a high-yield crop. They're designed to grow, adapt, and multiply. Now, saving is an incredibly important first line of defense. It's an absolute prerequisite for stability. But you simply cannot grow a massive financial harvest using just a shield.
To really see why this matters, let's look at the sheer mathematical magic of compounding over a 20-year horizon. If you leave that $10,000 behind the shield of a standard 1% savings account, it creeps up to just over $12,000, a super minor bump over 2 whole decades. But put that exact same 10 grand into the soil of the historical stock market, averaging around a 10% return, it skyrockets to roughly $67,000. That right there is the dramatic, life-changing power of putting your money in an environment where it can actually multiply.
Society constantly conditions us to believe that the great financial divide is between savers and spenders. We think, if I just stop buying lattes, I'll be rich. But that's kind of a myth. The real chasm, the place where true generational wealth is either forged or lost forever, is actually the gap between those who save and those who invest. That massive difference in those 20-year outcomes we just talked about, that is exactly where financial independence is built. So, if the math is undeniably in favor of investing, why is it so terrifying to actually start? Well, it's not a math problem at all. It's a psychological block known as loss aversion. Our brains are literally hardwired to panic at emotional volatility. Watching your hard-earned money drop 3 or 5% on some random Tuesday, that triggers our deep, primal survival instincts. When your money sits in a savings account, it never visibly goes down, making it feel incredibly safe. Investing fluctuates, and that normal, everyday movement feels dangerously risky to our brains. Because you absolutely don't want to lose your hard-earned savings, and hey, that is a completely valid fear, we need to bridge this gap safely. To make this transition without losing your peace of mind, we can follow a strict 5-step path. Step 1, build an emergency fund. Step 2, create mental buckets. Step 3, start small. Step 4, keep it simple. And finally, Step 5, rely on consistency. So let's break these down one by one. All right, Step 1. Before investing a single dollar, you need a substantial cash buffer. Why? Because the biggest reason people panic sell is simply that they need the money too soon. You've got to build a real, untouchable emergency fund, meaning 3 to 6 months of living expenses sitting safely in cash. Think of this as the financial equivalent of a fire extinguisher behind glass. It is exclusively for life's sudden problems. A medical emergency, a job loss, your transmission blowing out out of nowhere. It ensures that when life inevitably happens, you never have to sell your investments at a loss just to pay rent. Moving on to Step 2. This is where you basically hack your own psychology using a 2-bucket system. Bucket 1 is your safety money. It's padlocked, it's incredibly secure, and it does not move. Bucket 2, though, is your growth money. By forcing this mental separation, you are giving your growth money explicit permission to fluctuate. You stop checking your portfolio every single day in a total panic, precisely because you know your safety bucket is already locked down and doing its job.
Step 3 completely shatters the biggest myth in personal finance. You absolutely do not need to be rich to start. The goal right now isn't massive profits, it's building muscle memory.
Whether it's $50 or just the cost of a couple of takeout meals a month, starting small on a brokerage platform teaches your brain the habit of contributing. It's all about proving to yourself that the system works, because honestly, building the habit matters far, far more than perfectly timing the market.
Okay, step 4. Keep it boringly simple. Beginners constantly fall into the trap of crypto speculation or day trading, desperately trying to find the next big winning stock. Instead, the smartest move is usually using an index fund. Think of it like buying a single slice of a massive pie that represents the entire stock market. You get broad diversification, significantly lower risk, and steady, long-term growth across hundreds of successful companies, all without ever having to guess which individual business is going to win.
And hey, if you feel like you need some complicated finance degree to pull this off, consider this irony. The most successful investor in modern history, Warren Buffett, actively tells everyday people not to copy complex Wall Street maneuvers. His core recommendation for the vast majority of investors is simply to buy low-cost index funds. You do not need to outsmart the market, you just need to ride its coattails and participate consistently. Which brings us to step 5, relentless consistency. This is where the math truly explodes. Imagine investing just $300 a month, which is roughly the cost of a standard car payment, at a historical 8% average return. Over 25 years, that boring, repetitive action builds up to a staggering $285,000. It absolutely proves that wealth isn't about one lucky trade, it is about staying the course over time.
But wait, here's the truly mind-blowing part of that $250,000 figure. Out of that $285,000, you only contributed $90,000 from your own pocket over those 25 years. The remaining $195,000? That is pure compound growth. Just let that sink in for a second. Over 2/3 of your final wealth wasn't earned by you clocking in at a job. It was earned by your money working the night shift for you.
Now, even with that beautiful math, the market is still going to test your psychology along the way. So when headlines get scary and the market dips, anchor yourself to this brilliant analogy. Saving is like storing seeds in a glass jar. They are perfectly safe from the elements, but they will stay tiny seeds forever. Investing is taking those seeds and throwing them into the dirt. It gets incredibly messy, it rains, there are unpredictable storms, but it is the absolute only way to grow a forest.
And when those storms hit and the market inevitably crashes, experienced investors don't panic, they go shopping. They view market drops the exact same way you view a Black Friday sale. If you're investing consistently every single month, a market dip just means your dollars are suddenly scooping up more shares at a heavy discount. You're essentially spring-loading your portfolio for massive gains when the market finally recovers.
As we wrap up this explainer, the ultimate formula for your financial future becomes crystal clear. Saving gives you the anchor of stability, so you can sleep soundly at night, completely immune to life's random emergencies. But investing gives you wings. It ensures that one day your passive income will fully eclipse your living expenses, and you will never be forced to work for a paycheck again, unless, of course, you actively want to.
So, take a hard look at your own financial habits today. Are you still treating your money like fragile seeds in a jar, slowly losing value to inflation? Or are you finally ready to plant them in the soil and build real wealth? The step-by-step blueprint is right here, in your hands. The only question